Ever wondered why that juicy dividend yield might not be as appealing as it first appears? In the world of investing, there's a certain allure to dividend investing. It's like the siren song of the financial seas, beckoning investors with the promise of regular income and the potential for growth. And who wouldn't be drawn to it? The concept is simple yet powerful. You buy shares in a company, and in return, that company pays you a portion of its profits. It's like having a cash-generating machine that keeps churning out money quarter after quarter. But it's not just about the income. Dividend investing also offers the potential for capital appreciation. As the company grows and its profits increase, so too does the value of your investment. This combination of income and growth can be a powerful wealth-building tool. And then there's the psychological aspect. There's something inherently satisfying about receiving a dividend. It's tangible proof that your investment is paying off. It's a regular reminder that you're a part owner of a successful business. It's the financial equivalent of a pat on the back. A well-done investor, here's your reward. Not to mention the track record of dividend-paying companies is quite impressive. These are typically well-established firms with a history of profitability. They're the blue-chip stocks, the stalwarts of the market. They provide a sense of stability and predictability in an otherwise uncertain world. Indeed, the allure of dividend investing is strong. It promises a steady stream of income, the potential for growth, and the satisfaction of ownership. It's a strategy that has stood the test of time, delivering solid returns for countless investors. However, as with everything in finance, it's not all sunshine and rainbows. As we delve deeper into the world of dividend investing, we'll uncover some hidden truths. We'll explore the costs, the opportunity costs, and the risks associated with this strategy. So stay tuned as we expose the dark side of dividend investing. Let's delve into the hidden costs of dividend investing. It's not all sunshine and roses, my friends. You see, when a company decides to distribute dividends, it's not as simple as taking a portion of the profits and sending them your way. There's a little something called tax that comes into play, and it can significantly impact your actual return on investment. Firstly, the company needs to show a profit. This profit is not tax-free, it's subject to corporate taxes. So right off the bat, a chunk of that profit is heading straight into the government's pocket. This is the first taxation point, and it happens before the dividends even reach the investors. We're talking about a significant reduction in the total amount of profits that could potentially be distributed as dividends. Now let's say the company has paid its taxes and is ready to distribute the dividends. The investors, that's you and me, are ready to receive our share. But wait, there's more. Once those dividends land in our accounts, we're not off the hook. We also have to pay tax on those dividends. This is the second taxation point, and it's a direct hit to our return on investment. The taxman comes calling twice in the world of dividend investing. Consider this. Competitors of dividend distributing companies might decide to keep their profits in low-tax countries or reinvest potential profit for growing the company's stock value. This allows them to avoid this double taxation scenario and potentially offer a higher return to their investors. Some companies may even decide to buy back their stocks, which is another tax-effective way to increase the value of your stocks. This method makes the value of your stocks denser, rather than paying out dividends, which are again subject to double taxation. So while you are counting your dividends, the taxman is counting his share too. Remember, the world of dividend investing has its shadows, and it's essential to understand them before stepping into the light. Have you ever thought about what your money could be doing instead of sitting in a dividend-paying stock? It's a question worth pondering. The allure of dividends is strong, no doubt. Regular cash payments landing in your account, seemingly without effort. It's a hard prospect to resist. But everything in life has an opportunity cost, and dividend investing is no exception. Think about it this way. When a company decides to distribute dividends, it's essentially giving away a portion of its profits to shareholders. That's money which could have been reinvested back into the business. It could have been used to fund research and development, expand operations, or even acquire other companies. These are all activities that could potentially yield a higher return on investment over the long term. Moreover, companies that prioritize dividends may be missing out on another lucrative strategy: share buybacks. Instead of paying out dividends, a company could use that money to buy back its own shares from the market. This reduces the number of shares in circulation, making each remaining share more valuable. It's a tax-efficient way of returning money to shareholders, as it increases the value of their holdings without incurring the double taxation that dividends often do. Now, this isn't to say that dividends are inherently bad. They can provide a steady stream of income, especially beneficial for those in retirement. But it's important to understand the trade-offs. A company that pays out large dividends may not have much left to invest in growth opportunities. And as an investor, you might be missing out on potential capital gains. Remember, investing is about more than just immediate returns. It's about future potential, about what your money could be doing to grow. When you invest in a company, you're buying a piece of its future. So ask yourself, would you rather have a small piece of a bigger pie or a big piece of a smaller pie? Your dividends might be costing you more than you think. So the next time you're lured by the siren song of dividends, remember to consider the opportunity cost. Dividends are not guaranteed, are they? Let's delve into the risk of dividend cuts. Imagine this. You've invested in a company because of their attractive dividend payouts. You've been enjoying these regular payments, and then suddenly, the company announces a cut or even an elimination of their dividends. This is a very real risk that dividend investors face, especially during tough economic times. Why does this happen? Well, dividends are usually paid out from a company's profits. When the economy is booming, companies often have the luxury of distributing a portion of their profits to shareholders in the form of dividends. However, during economic downturns, profits might dwindle or even turn into losses. In such situations, companies are forced to make some hard decisions to ensure their survival. And one of these decisions could be to slash or altogether stop their dividend payouts. Now, you might think, well, that's a bummer, but I can live without those dividends for a while. But here's the kicker. When a company cuts its dividends, it's often seen as a sign of financial distress, which can lead to a sharp drop in the company's stock price. So, not only do you lose your dividend income, but you also see the value of your investment plummet. It's like a double whammy, and in worst-case scenarios, the company might never recover, leaving you with a loss that could have been avoided if you had diversified your investments or chosen companies with more stable dividend histories. But here's the tricky part. It's often difficult to predict when a company will cut its dividends. Sure, you can keep an eye on their financial health, but external factors like economic recessions or industry-specific downturns can come out of the blue and shake things up. This is why it's crucial to not just chase high dividend yields, but to also consider the company's overall financial health, the stability of their dividends, and the economic landscape. So, the promise of regular income might be more precarious than you thought. Dividend investing, then, has its dark side. We've peeled back the layers of this investment strategy, revealing the hidden costs, the opportunity costs, and the risk of dividend cuts. While the allure of regular income can be enticing, it's crucial to remember that companies need to show profits and tax them to pay out dividends. This can lead to double taxation, as investors often have to tax the dividend again. Furthermore, the competition may choose to keep profits in low-tax countries or reinvest potential profit, driving their own stock value higher. There's also the alternative of companies buying back their own stocks, a more tax-efficient method to enhance your stock value than paying out dividends. So, next time you're lured by a high dividend yield, remember to look beyond the surface and consider the dark side of dividend investing. Your investment strategy should always weigh the benefits against the potential risks and costs.